Listen up, it's official. Jay Powell just made markets go absolutely crazy as everyone was expecting out of this FOMC meeting. So today's video is going to cover the long short equity trade that I'm putting on in order to get my money outside of all this crazy volatility that is coming in the next following months. So that being said, let's get into it and I'll see you on the screen. So as always, we're gonna start with a broader macro/industry view for this idea in the month of September. It's not the only idea we posted inside our newsletter and in our Twitter channel, but as far as timing goes, this one is pretty much ready to go as of right now. So here I chose the transportation industry for reasons that we'll cover in a minute. And I just want to check a brief price action of the entire sector, right? So I picked the FTXR ETF to represent this price action in general. As you can see, didn't have a good couple of years in the past, and then last year, 2024, really did great. 2025 has been all over the place, but as you can see right now, it is approaching 52-week highs, and I expect it to keep breaking out. However, I need to mention that for this ETF, it is mostly weighted around airline stocks, which explains the momentum that we're seeing in it right now. As you know, American Airlines, United Airlines, and Delta Airlines beat on earnings unexpectedly, and those stocks started rallying as of the past quarterly results. Therefore, the momentum in the FTXR. On the other hand, this same ETF is underweight trucking and rail names, which I think could set it up for a sort of rotation if more interest starts to come into those trucking names. And that is what we're gonna get into next. So when we break down the relationships, the dynamics right now between airlines and trucking, we can see the following dynamics, the following themes here. So for airlines, we see that the market is not really paying up as far as forward price to earnings ratios go. It's trading at a 7.3 multiple, while the grand average or the grand total of the transportation industry itself is trading at 12.6. So that discount doesn't match with the above average forward EPS growth forecast of 45% above the 35% average for the industry. At the same time, I see sort of the opposite happening for trucking. Trucking commands a premium of 23.4 times when it comes to the forward price to earnings, even though the earnings per share growth isn't really there above the average, right? So in this case, I think that if you're in airlines, there could be a potential for the market to start pricing in this growth and give it a little bit more tailwind when it comes to those stocks I mentioned in airlines. But we're gonna focus on the unpriced potential of the growth forecast that could come to trucking, right? So the market is already paying a premium, but the EPS forecasts just aren't there as of right now. So our job right now is to figure out whether the market is right in assigning this premium and whether that EPS expansion could come to the industry. If we can land on that, then we got ourselves a pretty good idea. So let's just drill down a little bit more into what's happening within transportation and trucking as well. So when we drill down into the PMI executive commentaries, we can see right away that the trucking industry is doing worse than the 2008 financial crisis. And while most people will run away from this fact, I see it as opportunity, especially as the market is now pricing in a potential rotation and a potential expansion in earnings. Now, like I said, our job is to figure out whether the market is right. And if it is right, then everyone else is sort of wrong by discounting these stocks and selling them down, giving us the gap of opportunity. So as a leading economic industry, this is directly aligned with the broader slowdown in the economy when it comes to the business and consumer cycles. As you know, consumer spending has been a bit weak, the PMI readings have been a bit weak, and of course, unemployment has been weakening as we just got that 911,000 downward revision for the BLS, the most in history, by the way. So I think that the trucking and housing industries, both slowing down, reflect that weakening in the entire economy. So I think that tariffs and inflation are also top of mind for this industry drilling, right? So tariffs create a lot of bottlenecks, create a lot of last minute spending and new orders. And inflation is also affecting the dynamics of pricing when it comes to shipping, trucking, and all the orders that are coming in as well. So When we look at the PMI readings, right, as far as the specific industry goes, we can see that wholesale trade is expanding as far as the past quarter goes. So we have 3 consecutive months of expansion, and it is accelerating expansion. Therefore, we could expect, and as we see it, 3 consecutive months also of expansion in transportation and warehousing. So for me, this essentially means that wholesale trade, retail trade, which we posted in our last video, is going to keep seeing extended activity, extended expansion activity that trickles down into transportation and trucking, especially for those retail names, defensive names, and other products as well. This is all in the services PMI, right? We're not talking manufacturing. We're talking the one that's driving GDP right now, the one that's more important at the moment, and that is services. Therefore, that's our keyword here. But even with higher business activity and new signs of demand, whether it is a new cycle or just a tariff reaction, like I said, there's one ongoing problem. And that problem is the fact that price segments for services keep expanding month on month. As you can see on the blue line, that is this price segment for the PMI, and red you have the PMI itself for services. So there's a big divergence here, right? And we have to figure out whether those prices are going to keep affecting trucking the way it is now, or whether we can find the real reason why markets are overpaying for the industry itself. So for this, I would want to look for a stock that not only offers the trucking service, but also has some sort of software as a service, or SaaS, right? Why? Because if service prices keep increasing, then that's not only going to trickle down into the trucking service, but also the online space. As we know, all tech stocks right now are in high demand. They're the hottest thing ever. So if I can find a combination in the two, I think that is exactly where I could find that EPS expansion we're looking for. So that is where the comparables come into play. And as you can see, I highlighted Landstar System, stock ticker symbol LSTR, for a reason that we're going to cover in a minute, right? But the reason I chose it as a potential buy is that the market is overpaying as far as the forward PE goes. It's over 20.8 times, and the average is only 14.3 times. I think that is justified because of the forward EPS forecast. Analysts think that it could grow at 29.5%, while the average from the industry is 17.8%. You can also see a premium on the price to book of 4.8 compared to the 3.3 average. And you know, it's small enough. It's a $4.4 billion company. So I like those as longs. Why? Because it's much easier for it to go from 4 billion to 8 billion, giving a 100% return, rather than a company that's 100 billion going to 200 billion. It's a lot harder, right? We also see it at 66% of the 52-week high, so I think there's a lot of room for it to move higher. And then as far as shorts, I saw 2 potential ones in AirCap and Canadian National Railway. I chose Canadian National for reasons that we'll get into in a minute as well. But I mean, 80 billion, it's easier for it to discount if we see the X growth factor that we're going to check for in a minute. 78% of 52-week high gives me enough room on the downside, so that goes checking on the short list. For forward EPS growth, we see it growing at only 10.8%. Well, the average is 17.8. So it is fitting that narrative of going X growth. And those large cap companies, whenever they go X growth, that is a great sign of a potential short opportunity that you could take on. Then the market is valuing it right along the industry average. You see it 14.9x, and the average is 14.3x. So, you know, not the biggest discount, but I do believe that the future growth that is, again, under average is already priced in. As you can see in the price to earnings growth ratio, it's at 1.4 times. Well, the industry average is 0.4. As you can see for Landstar, that PEG ratio is only 0.7, which means there's still a lot of room for it to price in future earnings growth. That being said, let's go over the case for a long in LSTR and a short in CNI. By the way, everything I just said, it's in the Notion. I'll make it available for our newsletter subscribers. So if you want to download it, go over this by yourself as well. You'll have it there. So as I said, we're going to cover the reason why Landstar fits that narrative of not only offering the service in trucking, but also a SaaS, right? So Landstar offers a logistics software across the United States, which in a time of high inflation and bottlenecks could come into high demand. Why? This software aids in the efficiency, the speed, and the overall smooth processing of trucking, right? And as we see higher business activity, higher demand from retail, from wholesale trade, this is going to come in handy. And I think that is why the market is willing to pay a premium. That also aligns perfectly with our services PMI selection and justifies, again, the comps data that we've seen. For Canadian National Railway, we know that Canadian imports have been spiking in price this quarter, the most out of any other country. And most of these products that come by rail, again, through Canadian National Railway, are wood and metals, which are not in particularly high demand right now. We could check that in the collapse of building permits and all other US indicators, right? So we could see here in the permits, they've been declining for all of 2025 and most of 2024 as well. And we're now at a long-term average where if they keep breaking down, the housing sector could fall into an outright depression, right? When it comes to the builders, I'm not saying home prices are necessarily going to decline, but that is a bad sign for the overall economy. So if wood and metals that go into building homes are not going to be in demand and Canadian National Railway brings those in, I think it makes sense to see the company going X growth, which you can already see it in the EPS forward forecast. Let's just do a little bit of quick financial profiling. Again, like I said in the last video, this is not the entire financial analysis process. We go a lot deeper into companies. We do DCF models. We do all of the financial statements. We check where the growth and the contraction is. That could be a whole video in itself. So if you want to be a part of that, I invite you to check out our 5-day crash course for free, where we teach you some of everything that we do and come up for long short equity ideas. Link is below the video. I invite you to check it out after you finish this one, and you learn some of what we do as well. So going back to the financial analysis here, right? I highlighted two metrics specifically because I think that's the driving factor for these long short equity trades. So first of all, debt, right? So Landstar has only 13.5% of its balance sheet in debt, while Canadian National Railway has 49.3%. Big gap, which you can see in the difference between ROIC and ROE. Now let's look at capacity, right? Which of the two is in high demand? And you can see capacity for a Landstar is operating at 2.8 times. So it's oversubscribed. This actually the highest in the comp section that I picked, while Canadian National Railway is only seeing 0.3 times in capacity. So it makes it actually the lowest. So this confirms the thesis that we've been looking at. In fact, Landstar is oversubscribed in terms of the leverage it can provide through the software service, right? Because you can't operate a trucking business at 2.8 times capacity. So that leverage, that high capacity, the high demand has to be coming from the logistics software that they offer. At the same time, that slowdown in Canadian imports, that slowdown in demand from wood and metals, those rising prices through tariffs are hurting the capacity in Canadian National Railway. So that 0.3 is outright anemic. It's depressing. There's a good reason why this stock came up as a short, trust me. That being said, now we can start to look at the events that are happening now in interest rates. So with the low debt that Landstar has, imagine if they can take on a lot more debt at low interest rates and really expand and reinvest into that software and expand their network logistics. I mean, that could be the expansion in EPS that we're looking for, but let's not dream too far ahead. Let's just spread the trade, right? Let's look at the quote unquote technicals that we cover in the long short equity method. So first of all, correlations. We always start with correlations, and we can see that they're not the highest, but they're not the lowest. And I like the fact that they've been steady. So over the past 5 years, I know this chart says only 2024 because I like to focus on the 1 year and 2 year correlations mostly. But for right now, they seem steady enough to offer us two factors, right? Steady spreads and a reasonable opportunity to have the volatility in the actual position. So if you didn't get that, if you're not into quantitative finance as of right now, let me just give you a quick tip and explain what all this means real quick. a quick example from Jay's portfolio. He's one of our members in a free WhatsApp group that we offer, and he's actually looking to join our flagship program, The Sovereign Trader, real soon. He's seen the value in it. He's seen the opportunities that we can offer. And of course, this is something that I did for his portfolio to show him some of the methods that we use to cover our backs when things get ugly. So this is essentially a group of positions that he had in his portfolio. So you can see he had Baidu, Alibaba, Estee Lauder, Car Gurus, an ETF for semiconductors, and Celsius Energy. Now, correlations matter here. And as you can see, they tell you a two-way story. First, they tell you the fundamental or economic reasons, and then they tell you the quantitative reasons, right? So the technical, quote unquote. First, if you see Alibaba, it is mostly correlated, of course, to Baidu because they're both Chinese stocks, but it's surprisingly also correlated to Estee Lauder. If you cover the Estee Lauder trade that we gave you last year when the stock was at 58, it's now closing in on $92 a share. You're welcome, by the way. You would see that Estee Lauder's thesis is tightly tied to China. The reason is that China is one of the biggest sellers to the European region and the European economy. Estee Lauder also derives most of its sales from euros, so that exposure, of course, would make Chinese stocks highly correlated to Estee Lauder. So you could uncover some of this information just by looking at the data, and we trained you on how to do that within our program. So after we understand which stocks are correlated to others in long and short positions, we can kind of understand where the tail risk may be for the portfolio and where we should increase or decrease positions to cover our backs when the VIX gets high, when some of these relationships go higher or start to break down. So by holding a combination of some Chinese stocks, European consumer, and American consumer stocks, it turns out his portfolio was pretty uncorrelated by default, though he even admitted that this was pure luck and he had no idea that this was the case. The benefit here is that an uncorrelated portfolio can cover your butt in case the market decides to go crazy, as I mentioned, and also uncover some of our macro biases, as I just said with Estee Lauder and Alibaba, for example. Here's how this actually benefits you. As you can see, the variance or the volatility in the overall portfolio gets almost cut in half here because the average asset standard deviation. So if you held these stocks by themselves, your portfolio would have around 25.5% volatility on an annual basis. Now, with the portfolio standard deviation, taking into account the long and short positions he held, his portfolio volatility was now driven down to 14.9%. That is a very, very significant decrease while also keeping the upside potential in the positions he has. So what that means is you get to keep all your returns, you get to keep all of the upside, but also get rid of half of the downside potential and half of the bumps in the road in your holding period, which is, of course, something that every trader wants to achieve. We could do another video on that topic. If you're really interested in that, again, I invite you to join our free 5-day crash course on all of this. And if you're really, really serious about becoming a pro trader, I also invite you to apply for a flagship program, The Sovereign Trader. Going back to the spread between LSTR and CNI, we have the spread right here adjusted by the hedge ratio, which is right here, the 0.52. There's a couple more decimals into it, but that's, again, I could go a lot deeper into the hedge ratio. We have a Python model built inside our Excel models that come up with this data for us automatically. So when you chart this out, which by the way, you could chart it out in your friendly Thinkorswim platform. I don't know if TradingView does it, but most platforms will allow you to chart this as it is. So LSTR minus the hedge ratio times CNI as the short. You can get a pretty good idea of where the spread is trading right now. And I've also applied the mean and standard deviation. So as you can see, we're near a second standard deviation, which isn't, enough of a strength to buy into it, but it's also far enough from the mean, which is right here in the black line, for us to consider a buy, right? And we could actually get a lot more precise than this, which is where the Z-score comes into play. So this is like a smoother version of the spread that I just showed you, and it gives you really accurate entry and exit signs. So again, we're not close enough to the standard deviation that we want to enter into, but we're also far enough from the mean that this trade could actually turn profitable. And when you look at the stationary test of this trade, turns out that we have a 90% confidence interval that this trade is actually going to return back to the mean. So when we talk about returning to the mean, we could enter right now at around 78 on the spread, 78, 79, and then ride it all the way back up to 100 or 105. That is our exit target, which would be around a 35 to 45% return. So what my game plan here is, I want to buy half of my size position at the current level, keep the other half available in case it goes down to that second standard deviation, which would be around $70 to $72 on the spread. Of course, if I can get all of it at 70, 72, I'd be a happy camper. I'd get out at 100, 105. But I think the best way to go about it right now is to get half in at 78, 79. And if it goes down to 70, 72, then I get the other half in. But as always, the point is this: my exit target is 100 to 105. What this trade will allow you to do is serve as a benchmark for protection. I know that the FOMC is probably going to drive markets crazy for a while. I posted a newsletter on what I think will happen and the exact timing that I'm using to rotate out of stocks and into other asset classes. If you want to go check it out, link is below the video. Thank you for making it this far. It's been an absolute pleasure. I hope you got a lot of value out of this, and I'll see you guys in the next one.